Token Arthur was always curious about new things. One day, while flying over the jungle, he saw a group of animals exchanging goods and services using colorful stones. So he contacted FinTech CDOs from fantastic companies all around the world and collaborated with them to learn all about finance. Inspired, Arthur asked INSART CEO Vasyl to help start a podcast to share their knowledge with the world. This is what you are watching right now, FinTech CDO Podcast. Enjoy.
Hello, FinTech leaders and builders. So this is our next episode of FinTech CTO podcast. And I'm Vasyl Soloshchuk from INSART, FinTech engineer and partner. And today we have a really great guest, Brian Lanehart, CTO and founder for Momnt. Welcome.
As Brian says about himself, he's a high-performing, ambitious senior executive with a proven ability to drive innovation and support positive, long-term results for world-class organizations. His expertise spans strategy and vision, high growth, new business development, organizational architecture, and strategic relationship management with large enterprise environments. By cultivating a rapport with key stakeholders and team members across the business, he's able to boost collaboration, increase efficiency, and grow sales and profitability.
Thank you for having me. Excited to be here today.
Yeah, and thank you for joining us today. And Brian, to start, in 2023, Momnt was named as the best place to work in FinTech by American Banker. And they actually say that Momnt prioritizes taking care of its employees by offering competitive pay, great benefits, and a strong work-life balance. So perks include unlimited paid time off, because they believe culture is critical to success, and they invest in their people accordingly. They know that great work comes from well-supported team. And I believe that all the companies are reflections of their leaders like yourself. And my very first question is, so what is your impact as a leader to make Momnt the best place to work?
That's a great question. And thank you for the plug. I don't know if I could have bragged about Momnt any better than you just did. So thank you for that. That's an interesting question to answer. All the founders have kind of a special part of culture that we're very passionate about. You know, Barkley, one of our other partners, he's the CEO. He's very much about finding that 10Xer, that person who's going to come in and be passionate and devoted, and the company's going to pour as much of itself into those people as they're going to put into the company. Lena McDermott, our other co-founders, she's our chief people culture officer as well as our COO. She's really about something called toxic behavior carryover and caring about the behaviors that we carry from one business or one opportunity, one job into another, and how do we sort of go through a healing process and a maturing process. My specialty is really about playfulness. So I'm CTO, I'm also the president, and I'm really big on innovation. So my passion around playfulness deals with what is also known as psychological safety. So I know that if I can play around with you, if I can joke around with you, we can be silly together, and I can laugh at myself and you can laugh at yourself, or we can laugh at some problem together, we're both going to be very relaxed, which allows ideas to flow. Natural solutions come to the surface that in a high stress environment, a really judgmental environment, a harsh micromanaged environment will just never present themselves. So part of what I really try to push into the company is that sense of playfulness, that sense of trust that really reinforces the psychological safety. It's okay to have crazy ideas. There's probably a really good idea in 10 crazy ones. It's okay to ask a question where you think you don't know all the answers. We're going to play together, we're going to learn together, and we're going to grow together so that we can really engender that innovation that's so important to a FinTech.
So how can you measure if you're really playing or not? So do you have any metrics or a sense of that you're really moving in the right direction, or that it's becoming a little bit more boring, a little bit more like, more like a process like approach rather than innovation-like approach?
So one of the things that we keep an eye on are, from an engineering perspective, the time between ideation and implementation. Like how long does someone in sales has a recommendation, that product then talks to the engineers, then how long between that sales idea, that opportunity, and it gets into production? The longer that takes, the less innovation there is. The longer that takes, the more bureaucracy, the more process, the more focusing on how did we do this? Did we get the right buy-off? The political stuff, was it a decision by committee? The longer, the lower the innovation is. So to a certain extent, not completely, but to a certain extent, delivery velocity is a great indicator or measure of that innovation. And then sort of on the playfulness side, if I'm participating in a discussion, I'm looking for body language, I'm looking for intonation, even across cultures, because we have people from Croatia, from Mexico, from all over the world that are coming in on the engineering delivery side to collaborate. And so I have to learn. So a part of the culture is getting to know our people. And as we get to know our people and their cultures and how they use language and intonation, we look for those cues. Is someone reserved in expressing an idea because they're afraid they're going to get judged? Well, we have conversation starters that we use to help them open up. Sometimes we'll take them aside and say, I know you had a really good idea. I want to hear it, and then once they express it, why didn't you express it in the group setting? Kind of a thing. Or if the sarcasm starts to get more biting, if people start making fun of other people as opposed to themselves or the environment, we look for those cues during a discussion and we try to diffuse them as quickly as we can, so we get that sort of humor and playfulness, that psychological safety, so that everyone's interested in sharing their ideas. And then we go back to the measuring. Okay, we had this idea on a Monday. It was a simple idea. Did it get into production by Friday? Did it take 2 weeks or 2 months? If it took 2 months, why? What were the blockers?
So I recently learned that innovation is not about what you're gonna do, but more about what you will not do. And as soon as you foster in the safe environment, you foster the idea that everybody can express their ideas, share their ideas. Sometimes you could be stuck with so many different ideas and actually prioritizing all of them rather than building some specific stuff. So how do you deal with that that kind of situation when you need to prioritize lots of ideas and maybe not to do many of them rather than building all of them at once?
That's a constant juggling. There's kind of a constant negotiation, but it all starts with, we believe in very much decentralizing sort of the control and the decision-making authority into the organization. So step one, remove the bottlenecks. So many other fintechs, like, I want to change the color on a button. Well, I got to get the CEO's buy-off. Like, we don't do that here. We have product people who own specific aspects of the business, and we expect them to make those decisions, and we expect them to make them quickly, rapidly, and accurately over time. It's okay to fail fast, but learn from your mistake and make fewer of them as you go along. So by decentralizing, we remove a lot of those roadblocks. By finding people that we trust to make good decisions during the early days, we work with them to make sure they're making the right decisions the right way, and then we trust them to go off and make those decisions. And the product people and the decision makers that are doing the implementations, they'll know, they're like, I'm not sure about this. I'll pull someone in from the higher levels to come and help them make a decision. And then we meet quarterly on just general strategic direction. These are the strategies that everyone should be, deploying into the organization over periods of time. And so they always have those guardrails. And then the other aspect, the other dimension of it from the top, we generally look at our quarters and our, every 3 months, every 6 months periods. This is where we're going to focus on revenue growth at the cost of operational efficiency and at the cost of profitability. Next quarter, next period, we may focus on nothing but risk mitigation. We're going to really tighten our risk controls and put more risk controls in place. And then, so we have these large periods of time where there's a general theme for the organization. So the organization knows, I should be focusing this time on operational efficiency. I should be focusing this time on just raw profitability. I should be focusing this time on risk and risk mitigation. And then we trust them to make those decisions.
Brian, to set a perspective, so what is the size of your organization right now, like the whole company and specifically the engineering department?
So we have about 225 people now. The engineering department, if you include DevOps, information security, IT support, we're probably 45, 50 people, somewhere around there. That includes software engineers and QA.
Okay, and Brian, so you mentioned that you actually wearing several hats. So you're a founder, you're president, you're chief risk officer as well, and you're a chief technology officer. So how would you prioritize, what is your primary role, what's your secondary role, etc. So how you juggling all this?
That's a great question. So when we started the company, my primary role was technology officer, and I was really focused on laying the foundation of engineering growth and scalability. That was largely set. The second role I moved into was a little bit more the risk officer. Now that we've grown to where risk is a primary focus, I'm helping build out same kind of approach. Let's build out the risk department, hire a leader who can go execute risk and risk strategy, make sure they're set. My everyday number one priority is overall corporate strategic vision. and approach. Like, how are we approaching markets? How do we approach new markets? How do we go into new markets? Things of that nature. Working with sales, working with legal, working with risk to make sure we're entering them the right way. But when the company was founded in 2019, we always start with a strategic vision. And the strategic vision was twofold. It was corporate culture was very, very important. And then why are we going after the industries we're going after, the what's and the whys? And then shifting over to a pure technology officer, let's lay the engineering groundwork and foundation. And then as we grow, shift over to risk and help doing the risk controls. And then once those two pieces are mature, go back into being that president where it's more about strategy and vision.
Yeah, that's really an interesting evolution of the roles. And before the Momnt, actually, I see that you were in the consultancy business for about like 20 years. And like a technology consultancy, yeah. So why did you during that time? So why did you prefer actually to run the technology consultancy rather than having a full-time job or like doing your own product like much
Like
earlier
Momnt.
than and being a founder of like a product company much earlier? So what was the reasoning actually to run this technology consulting for so many years?
Well, part of that answer lies in what I did before the consultancy. I'm a serial entrepreneur. So I was recruited out of college to help grow a company. I grew that company, we sold it. I went over to that company, we grew it and sold it. I went to another company, grew it, and then grew it for a large extent, and then went to another company and grew it. So when I entered the consultancy phase, I was tired, quite frankly. I was tired of the startup grind. I was like, I'll go be a freelance consultant. I can kind of hang out, control my own hours. I do get bored quickly. So one of the fun things about a consultancy, it's always a different problem in a different context on a different day. So I wasn't really bored. But then after a while, I sort of got that itch again to go, you know what, I kind of want to go back and start my own thing. And so once I had a couple of years of consultancy and technology strategy under my belt, I was like looking at the industry, looking at FinTech, and I found two amazing people to start this company with, and we had a vision and we went off and executed. So I really was that consultancy was to take a break from the startup grind, somewhat ironically.
Yeah, and by the way, I see that this is a pretty natural path when the founder actually run their business and then they make the exit and they start doing the consultancy, sharing all their experience with other entrepreneurs and founders on the business side, product side, technology side, depending what is their expertise. Yeah, and it looks like a break, some kind of break, but also like a knowledge sharing and experience sharing.
It's a giving back, very much.
Yeah,
very much so, giving back to the community.
Yeah. So anyway, so what are the biggest lessons learned running the consultancy actually?
Running consultancy, it's very difficult to do alone. Like I was a single person consultancy trying to keep a sales pipeline full and then trying to go execute the vision, helping these other companies grow. It was very difficult. You get really good though at finding common patterns across industry. I mean, literally across industries. A large part of my consultancy was in the legal industry because the legal issues and legal problems that large law firms are trying to solve had been solved by other businesses. They just didn't have a technology business mind come in and say, this is the best way to solve the problem. It was always surprising to me to go, I've solved this type of problem before, the application's a little bit different. And so understanding how to solve even if it's the similar problem from a different industry, you're still kind of solving the same problem. So the lessons learned was, how do you diagnose a problem quickly, even if it's a large enterprise? Like here's a $100 million law firm that is struggling to make profitability out of some department. Like that's a big problem. But you realize when you look back in your past, you've solved this problem so many different ways, so many different times. You take all those learnings and reapply them. You get to remonetize all the work you've done in your past. It can be a lot of fun.
You also spent a couple years in Green Sky. So what was the most exciting part of this journey?
In Green Sky? Green Sky was also kind of a break from the consultancy because, being a single consultant, you're churning through getting new clients. I was like, I just need to go hang out at a company, catch my breath while I work on my next idea. So Green Sky learned a lot about how a very large organization worked, because by the time I got there, they were 800 people. It was probably the largest company I'd ever really worked for. So understanding how all those large departments kind of work together, all the interdependencies, and then understanding that in large companies, there are natural silos that develop, and then figuring out how to kind of break those down or come up with a strategy so that when we do build a company, we don't have those natural silos building.
So you're actually a founding CTO at Momnt. So let's touch a little bit. So what was actually the trigger events when you decided that this will be your next big thing for yourself as a founder?
We saw a lot of market opportunity. One of the there were several triggers. One of the triggers was just the size of the market. Like in North America alone, it was, I don't know, I can't remember what the number was, $2 trillion. Like it's massive. It's a massive market, the unsecured financing market in North America. That was a big one. And we did an industry view. We looked at all the people that are in the space, from traditional lenders like the Wells Fargos, the traditional banks, to sort of what we call the FinTech 2.0s, the Affirms and the Klarnas that were taking a more innovative approach to it and saying, what are the gaps? What does the market really want? And could we build to those market gaps? Of course, the answer was yes. But a lot of the gaps that we saw was no one was really approaching unsecured finance like MasterCard and Visa. That was the really big gap that we saw. MasterCard and Visa, for example, is a revolving card. They're taken everywhere. It's ubiquitous. And that was really what Momnt is trying to do from an installment loan, not a revolver. If you want to get into the differences of those, I'm glad to, but it's an installment loan versus a revolver. No one was approaching the market like MasterCard and Visa. We wanted to be part of the infrastructure. We wanted to be part of the fabric of these loans, and then also layering on how the payments from the loans are put into place. No one's using innovation in the recent innovations. By recent, I mean the past 10 years of what's been going on in payments and embedding those features and functions into the installment loan process. So we just saw a lot of opportunities, a lot of gaps that we felt were pretty easy technically to fill that we could go after. So we did.
So I'm trying to reverse engineer the decision-making process, how to start your new company. And what would be your advice for somebody who are for years in some industry, in some market, like within the fintech space, and they are looking to, and they're actually subject matter expert, either they're on the business side, maybe technology side, and they're looking into the market. They see some problems, but what would be the most efficient way to decide whether they should start something new or they shouldn't do, or maybe like select between several ideas, several pain points and challenges that they would like to address with their new venture?
I would say a lot of people don't look at it from a side of risk. Like, what's the risk of starting the venture? A lot of people, especially, in my younger years, it was like, oh, this is a great idea. I don't see anybody doing it. And by I don't see anybody doing it, I didn't do any market research or analysis or competitive analysis. Like, it hasn't entered my sphere of influence. Nobody must be doing it. I'm going to go after this business. And then, 6 weeks or 6 months doing research, it's a crowded marketplace. So look at it from a risk perspective. When we started Momnt, we went after an industry that had a $2 trillion TAM. That's massive. That's super low risk. That means, and then we looked at how many competitors are in the space and how much market share does any one competitor have. No competitor had more than about 3% of market share. That's a big opportunity. We could come in and do 2%, 3% market share and be $1 billion company for a $2 trillion marketplace. So look at it from a risk perspective. If I take a 1% or 2% of the market share and the market's only a $10 million marketplace, that's not a lot of money. The risk is very high for success and profitability and sustainability. So the first step is go after a large market where there could be a number of players, but no player has more than maybe 5% of the market share. And then look at it from, why does no player have more than 5% of the market share? Is it a feature thing? Is it a gap thing? Do they not understand what the industry is really wanting? Are the industry players in the space, 10 years, 15 years old, and they're just beyond the innovation curve? Is there some new technology or operational efficiency we can bring to solve these problems? A lot of entrepreneurs will say, I have this problem. A lot of other people might also have this problem, which is largely true, but they don't look at it in the context of all the other people that are in the space. And so look at it from that, this is advice. There are many other approaches. This is not the only approach, but also look at it from a risk perspective. If I only get 2% of the market share, is it a $10 million, $100 million marketplace, or is it a $2 trillion, $3 trillion marketplace?
Yeah, Brian, thank you for sharing this. And so first time when we met with you, so you actually mentioned that you have done something differently when you started. So you not like the other startups, not like the other startups developing a kind of MVP approach. So what was done differently from the very beginning in terms of the technology and the product development?
So we built what we had confidence the industry wanted and needed. We didn't do let me do a small thing and test market it, do a small thing, test market, do a small thing and test market it. I designed I designed the platform version 1.0 that was very full featured. I'd say there was a whole bunch of people here that helped with the implementation. It was a team effort, but we didn't just say, here's a consumer application or here's a way to gather consumer information and spread it against a bunch of banks. We said, no, we're going to gather the consumer information. We're going to KYC them. We're going to embed all the compliance and regulations. We're then going to do a soft pull of credit. We're then going to build a multi-offer engine. We're then going to build an allocation engine that dynamically allocates the consumer applications to a host of banks. We're then going to do real-time closed loop payments. And then we're going to push all that into market. Part of that was because it's a turnkey platform. So unless you have really all those pieces in place, the platform doesn't have a whole lot of value as a turnkey solution. But it's a risky decision. The reason why we took the risk is because, again, my two co-founders, Barclay's a quantitative financial analyst by trade. Lena is a credit underwriter by trade. Like she has 10, 15 years doing consumer credit underwriting. So we knew all the pieces. And so from my perspective, we might as well just build it all and then put it into market and then test it and start iterating from there, as opposed to, let me take this one small feature and see if the market will adhere to it. But the confidence came from, we had 10 or 15 years across the three of us in the industry. We knew what the industry trends were. We did a lot of market research and analysis to see where the industry was going, see who the market players were, see what the gaps were to build to those gaps. So it was a little bit different. We built a scalable enterprise class application as our version 1, as opposed to what a lot of entrepreneurs will do, which there's a lot of wisdom in as well. Let's take something that's almost no code, low code to throw up a prototype to see if I can get some attention, and then I'll kind of build on it from there. We took a very opposite approach. Let's build enterprise class, horizontally, elastically scalable application stack that has all the features, and let's go after the market very aggressively.
Yeah, so you actually had the real knowledge in the market, and you were very confident of what you're building already, and actually the strategy, as I see, it was a pretty efficient strategy. And during the last 4 years of Momnt, you have grown significantly, and you're over 200 people now. So, but still, when you are growing that aggressive, so there could be some scaling challenges. So what kind of the biggest challenge for yourself in terms of scaling is that right now?
A lot of the scaling challenges were more on the people and organizational side than the technology side. The nice thing about growing a company in 2019 is we're cloud native out of the gate. We get all the benefits of being horizontally and elastically scalable. My engineers had experience building those kinds of applications in the past. So it just sort of add water. Here's a horizontally scalable application. I'm making it sound a little easier than it was. And so a lot of the challenges were more about because we deal with banks. So there's a lot of compliance headaches and nightmares. And so we hired somebody that had a history of doing nothing but chartering banks. And he came in and said, here's everything you need from a regulatory perspective. Let's get all that paperwork. Let's make sure we're doing all the right things the right way. That was a big challenge. And then going from, I think we had less than 10 people in 2019 and growing, to 200 by the end of year 4, making sure everyone understood the seat they were sitting in. There's a lot of focus on culture. Do you understand this role? Do you not only understand this role, but do you understand how it impacts the people to your left and to your right, so to speak, in the work stream, and the people above you and below you? So spending a lot of time on teaching and training all the positions to make sure they understood when you make a decision, it's not just about checking a box, coming in 9 to 5, check a box and go home. It's more about being thoughtful about what you're doing, why you're doing it. And then one of our other philosophies on the people side is, I want to pay a computer to be a computer. I want to pay a person to be a person. So when we talk to people in the organization, are you doing a lot of copy and paste between screens for some reason? Automate all that, because I want you to be able to think willfully about what you're doing. On anybody that's external to the organization, I want them to be able to focus on the relationships they're developing, not on, did you give me the right information so I can make a decision? Like, a human should never do that. Humans are amazing at developing interpersonal relationships. So let's make sure we understand how to train our people so they can focus on those, either internally or externally. That was a pretty big challenge to grow this rapidly, this fast.
So at this size of the company, when you're a CTO, you're less into technology now, but more into the organizational design. And this is all about like how you would structure your team, how you would structure the communication between all the team members. So my question is, like, do you use any kind of specific framework for the organizational design or not? So, and maybe it's some of your your own customized framework. So can you tell us a little bit more in that?
We use, I did a lot of organizational psychology and organizational hierarchies theory back in college. So I'm relying on a lot of that education and training. You know, we willfully approached it going, this is going to be a decentralized organization from an organizational structure perspective. But as important as that kind of a strategy is, every time, you know, the first thing that was built technically was the DRD, the database, the data model. And every time I'm designing a table or a table relationship or a column, I'm asking myself the question, is this going to make someone's life easier or harder? A human's life easier or harder? Because if it's going to make it harder, I need to figure out how to make it easier, because it will never be cheaper than now to develop that ERD, the model, the logic, the business logic that goes behind all of this. So the approach was very, very willful in the technology. It needs to be a mirror reflection of the organizational structure we're putting in place, and the organizational structure needs to be a mirror of the technology that's enabling that organizational structure. And I think a lot of technical entrepreneurs sort of get lost in that. They're so focused on the technology, they forget that, okay, but humans have to interact with this. You know, if someone calls into the call center, they need to be 2 clicks away from supporting the customer that's calling in on the call center. Did you think through how you're going to surface that data through the application, through a workflow piece, to make sure that they can get the information as fast as possible, so they can answer the question of the person on the phone as quickly as possible to the most extensive degree they possibly can. So everything is a willful decision to think about all the ripples a technical design or implementation makes in the lake or the ocean that is Momnt, going from our banks. It's a little bit different in that I haven't seen this approach widely before, but we have an application that is a single unified application, but it has many different perspectives and views. So if you're a merchant, you have a particular perspective on the application. If you're a lender, you have a particular perspective on the application. It's still a single application. And that was very important from a data coherency perspective, from an overall operational efficiency perspective. Everyone's always looking at the same thing from their own unique context or perspective. And then making sure when you surface whatever the data is or the business logic you're implementing, you're making a human's life easier. And so that goes back to, you know, people believe in the work-life balance because they don't have to spend, 10 clicks or 15 minutes trying to find a piece of data to answer consumers' questions. The humans more satisfied. The call center people, for example, or the merchant success people are more satisfied because they can get an answer very quickly. They have higher job satisfaction. They're doing a good job at lower effort. So when we design the technology, we make sure the technology mirrors the operational structure of the organization. And as we design the organizational operational structure, we make sure the technology mirrors that as well.
Mm-hmm, mm-hmm. So am I right that the product and engineering teams, they both report to yourself?
They actually don't. So the product team reports to Lena, our COO, and then all the engineering reports to me.
Okay, nice. So this is a pretty typical design within the fintech and technology companies when you have a product and engineering team. So, and you also mentioned that it's very important to have this efficient communication between different parts of the team. So can you give us maybe some insights how to establish this efficient collaboration between the product and the engineering team so that they are hearing each other, because it's very important to implement the technology and product strategy?
We're very fortunate. This is a reflection of the humans we were able to recruit, retain, and hire. It's a reflection of them more so than the company. The engineering teams and the product teams, they collaborate really well. Like they cherish each other. The relationships, going back to the sort of the playfulness and transparency, that's embedded in the organization. So when an engineer has a question about a business requirement or an idea about this logic doesn't make sense, can we do it some other way? Almost never, very rarely are they apprehensive about sharing that with their product owner or the product managers. And the product managers are constantly asking for feedback from their specific engineering teams to make sure they're doing it as efficiently as possible. Because we try not to make decisions one-dimensionally. The business wants us to make profit, okay? But there are 1,000 different ways we can implement this solution. What's the most efficient, not only for now, but in the future direction that we're trying to go? And so the engineers are very good at going, I understand this aspect of the application. I understand the architecture. I understand the patterns. We should be heading in this direction. But product, you're asking me to kind of what sounds like to do sort of a 90-degree turn from where we're going. Let's have a conversation and go forward. I say all that, the product and the engineering teams have a very close relationship, and they do things to engender that. They're playful with each other. They check in on each other. We know when, it sounds silly, but we know when people's birthdays are. We know when people's family members are sick, and we send them things to let them know that we're thinking about them, because even though they're in Croatia, even though they're in Latin America, they're part of the family, and we treat them that way. And that goes a long way. I mean, we never have to go, engineer, you didn't show up yesterday. You know, I didn't feel good. I had to take my spouse to the hospital. They're telling us days in advance if there's a family emergency, if there's something they're going to have to go through, and we give them the time and space to go deal with that and then come back, fully refreshed. So we really spend time focusing on the interpersonal relationships between our product and our delivery teams, and they do an amazing job with that.
Yeah, so that's really important to have the really motivated team to implement this strategy. And so I have read on your LinkedIn profile that you're really into everything related with the technology strategy. And
Yes.
Sometimes when people talk about the strategy, they can mean lots of different things. What is that? So what is technology strategy for yourself? How would you define it? What is that?
It is the roadmap or vision that we're creating that supports the business goals, the business strategy or vision of the founders and the board. I mean, that's it in its simplest terms. And so, which sounds oversimplified, but it's also difficult to pull off. A lot of people think technology strategy is, I'm going to go build a horizontally scalable application over at AWS or Azure or Google or wherever, but they don't think about how they're implementing those changes to the benefit of the business. In opposite times, the business will often go off and say, I want to head in this direction, but I'm not going to tell the engineering and implementation teams until it's sort of too late or the decision's already made. When you really need to come to the table together and say, I want to go in this direction. This is, and then engineering and implementation products gang, this is the best way to implement that idea. Where else do you want to go? Let's make sure we're laying a groundwork or framework that allows you to go in other places too. And so it's really, going back to kind of something you hit on earlier, we have so much experience in the industry. We knew where we wanted to go, and we've been very fortunate to be largely, based on market feedback, we've been largely accurate. And so the foundation that we laid, we're still building on and moving in that direction. And so it was about the business and the implementation, the engineering and delivery sides coming together saying, this is the vision, this is how we implement it, this is where we're going from now and 5-10 years down the road.
So when you say the technology strategy is a roadmap, so do you mean this is several steps within the what time frame? How many steps?
Sure.
And should we? How deeply we should go describing the strategy, or we should have just a brief roadmap? Because again, the strategy can change, over time. So the situation changes, it changes as well. So what's your insights into that?
So when we started the company, we planned in 1 year, 3 year, and then 5 and 10 year. That was our plan. That, and it was a roadmap, but it was a very, very, to your point, it's a very loose guided roadmap. And as we go out from 1 year to 3 years to 5 years, the road sort of gets wider and wider because there's more chance of change as you go down the path. And then we plan in month and quarters for actual execution. Does that make sense? So it's sort of a balance between what's that long-term vision and strategy? Is the market giving you feedback? Let's make some adjustments, but we're only going to implement, in 30 day to when we have 2 week sprints, but we kind of think about implementation in 30 to 90 day implementation. So monthly to quarterly. So we have time to make adjustments long down, further out, but we still know where we're going. We still know the mountain that we want to climb. And
how frequently would you adjust your long-term strategy?
We haven't really adjusted long-term strategy since we started the company, to be quite frank, which is very unusual. But we adjust our roadmap items based on priority, based on market feedback. So something we want to implement in third quarter, we may move up to first quarter, and something we want to implement in first quarter, there's not as much as the market needs, so we can push it down to second quarter or third quarter. We'll make those changes, in quarters, but the 5 year, 10 year roadmap largely has not changed.
So do you have any established process to adjust the quarterly or annual strategy, or you do this when some events happens or when you achieve some goals?
We do the roadmap reviews monthly. So every 30 days, we're looking at the roadmap, and looking at the roadmap really means, is this the right priority order for implementation? So we do that fairly frequently. And then at least yearly, the executives go on a retreat, usually in October, to say, what do we want to accomplish in what did we accomplish in 2023? What do we want to accomplish in 2024? And then that helps guide the monthly conversations with product delivery for the individual priorities.
So do you distinguish like a strategic management or non-strategic, or let's say tactical management for yourself somehow?
for me personally.
Yeah, for you personally, yes.
It's a little bit of both, because, you know, working with senior leadership in the board to say, this is what we're going to accomplish in 2024, and then coming back to the engineering side and say, in order to accomplish that vision, these pieces have to be in place by these times, you know, quarterly, and then letting the delivery teams implement that more tactical plan to say, okay, this will be implemented this month, this quarter, for the accomplishment of, you know, those goals and those reasons.
So what's the difference for yourself between like strategic and tactical management? Like any difference in the communication approach with your team members and the leadership?
No,
or on the more
that's a really good question. We really believe strongly in the transparency, and so I'll go to the delivery teams on the technical side and say, we need a data orchestration layer. That's kind of that's a large project that has a lot of implications. And they'll say, okay, cool, I love a data orchestration layer, for example. Why? And I'll say, here's all the strategic reasons why. Having a data orchestration layer in early 2024 will enable us to do all these other strategic initiatives. These other strategic initiatives help increase the value of the company. It helps decrease risk. It helps our consumers have, you know, whatever the reasons are. And so I make sure they understand all the strategic decision making, and then that's their opportunity. There's a frequent opportunity, monthly or quarterly at least, for everyone to comment back on the strategic direction that we're taking, because it's not a one-way approach. You know, we set the strategic vision. We come down and say, we believe we need these tactical implementations to achieve the strategic vision. Largely, they say yes. Oftentimes, they'll say yes, but what about if we also do this? Then we can achieve strategic vision number 2 sooner than strategic vision number 1, whatever it is. So there's a constant feedback loop that's going on. And we're constantly walking that bridge, going back and forth, saying, you know, this was a strategic goal. Is it still important? Maybe it's not important. What tactical implementations are we doing that achieve those strategic goals? And do we need to make adjustments?
So, Brian, there is a funny statement saying that the corporate culture actually eats the strategy for the breakfast or maybe for the lunch. So what's your experience with that when you set some strategy, you have this roadmap, but because of the team culture, corporate culture, you're starting actually to move to the other direction, not as you actually planned in your strategy?
We haven't had a whole lot of that. There have been a couple of market conditions that have caused us to adjust direction a bit, but we knew they were coming. They were already on the roadmap, and so we would bring them forward and shift some other things later. We haven't had a whole lot of we haven't had almost any strategic changes in direction. We've had a lot of small to medium-sized tactical execution order priorities shifts all along the way. We thought this was important, but this is more important. You know, we had a risk event. We need to put a control in place, push this out, put the risk control in place, bring that back in. So that's going on pretty constantly.
Yeah. So you have this feedback loop
Yep.
within your organization, which is really great. So let's talk about Momnt actually. So Momnt is a point of need landing, as you say. It's embedded landing solution for business. And my question is, why specifically for home improvements and healthcare needs? Because this looks like pretty niche solutions. Still, you mentioned the TAM was really huge from the very beginning. But anyway, so why specifically these two areas?
So specifically home improvement, because from a lending perspective, the greatest indicator of loan payback is home ownership. So that's the lowest risk segment. So we're a startup. We're lending money into the market. What marketplace is, what sub-industry, whatever, what consumer is most likely to pay back the loan? That was the simplest answer. Let's go into home improvement. Let's cut our teeth. Let's get some experience. Let's get some knowledge. These people are probably going to pay us back. They own a home, and this project is adding value to their home. It was a risk decision, which is pretty, it makes sense when you think about it. I wouldn't go after general retail or e-commerce, because the history of those types of loans aren't as strong as home improvement loans. Pretty simple and straightforward. Medical is not too different than home improvement. We have some experience in medical, so that was the second one. And we went into medical because we had experience, but we also went in to prove that the platform is vertical agnostic. So a lot of our competitors are home improvement only, or medical only, or general retail e-commerce only. Like, the point of the platform was to be vertically agnostic. And so to go into multiple industries at the same time was to show that, hey, we can go in any industry at any time that we want. But really going into home improvement really was about the risk.
So do you have any plans into other categories?
We do. We have lots of plans for lots of other verticals.
Can you share this or not?
Sure. The next one we'll go into, so we're unsecured credit today, which is like a credit card. There's no collateral. In 2024, we plan on doing secured credit. So think, if you have a whole home generator, we can use that generator as an asset, as collateral against the loan. Also, we have a strategic investment from Yamaha, the motorsports and water sports division. So maybe we'll be lending against boats and four-wheelers, and securing those assets will be securitization for the loan. And then we have plans to go into general retail. We know certain segments of the market where these types of loans would do well for e-commerce.
But are these decisions also based on risk assessment, or you're trying to cover more categories, even with even taking more risk here?
It's both. One of the other things that we always look at a risk segment. We always look at the riskiness of the industry before we go into it. And the way the platform is configured, it can have many different credit policies for many different contexts. So if we want to go into general retail, we would create a credit policy that will perform well in that segment versus home improvement, because a general retail consumer behaves differently than a home improvement consumer. So we need a different risk policy to implement for that risk segment. And then our largest loan size right now is 55,000. So in 2024, we'll increase that to 150,000 and then beyond. So there's a lot of segments where people want, in home improvement, it's obvious, I want a pool and a pool house. Well, here's a $500,000 loan, but to your point, that's a different credit policy. Maybe we'll put a lien on the house or secure the house in some sort of a way, and then go into those market segments. So there is definitely a risk assessment that comes along before we enter a new industry.
Okay. So Brian, I have read the article by you. So the name was the 3 questions to ask before adopting an embedded finance platform, back to June 9, 2023 in Payments Journal. And so one statement catched my eye. So what it was about, so you stated, but as all developers know, convenience on the front end often means complexity on the back end. So can you unpack a little bit, what does it mean specifically with Momnt?
Sure. So on the merchant side, if a merchant is choosing a finance partner to partner with, they have to look at the whole experience. It may be super easy to onboard a consumer and get loans, but how do I collect the money from that loan? Oftentimes that's a very complicated process. How do I reconcile does this integrate with my finance program? How the merchant uses to run their finances for their business. Is it easy for me to reconcile this money in my finance program? Do they offer me reporting? Do they offer me intelligence? Can I get paid in real time? Are they charging me interchange for the payments for some reason? It's looking at it holistically to make sure that it's easy to onboard, it's easy to manage my consumers, I have complete transparency into my program, the money reconciles same day or near same day, they don't put a whole lot of friction or risk controls on me such that I can't operate my business, and the reporting is transparent in real time, so I can always see what's going on, I always know how much money I'm making, I always know how much money participating in the program is costing me. Asking all those questions holistically to make sure I'm choosing the right partner.
So how do you achieve this frictionless user interface for the underwriting process, which is always a challenge for the lending platforms, and it's really very crucial for any embedded finance platforms?
Yep. One of the philosophies we employ on the technology design implementation is we will always accept the complexity on our side for the benefit of the humans on the other. So when we look at merchant underwriting, for example, and the consumer, we take as little information from them as we possibly can to make a well-informed risk decision. On the back end, there's machine learning models, there's multiple data partners, there's multiple scorecards. We're individually scoring each individual attribute, then we build up this overall risk attribute that leads to an approval and a risk segmentation. So that's the complexity on the back end, but I ask as little information from the user on the front end as possible so they can have as clean as a low friction experience as possible. So like I said, just to restate, we will always try to take all the complexity and put it into the application so that the user on the other end can have as simple an experience as possible.
So you present real-time loan offering based on like alternative data sources. So what are these? What do you mean by alternative data sources?
Right now, right now we look at credit in a different way. Soon we'll be adding additional elements depending on a risk segment. You know, if you're what's called a thin file, maybe you have history with your, I don't know, your utility. So we'll start pulling utility data or rent data or whatever other data. But really what we do right now is we don't just look at a consumer's credit score as a point in time. We look at it over time. And we find that there's a velocity, there's a vector on credit scores. It's going up, it's going down, it's going up aggressively, it's going down aggressively. And I can show you 825 credit scores that were behaving like 690s, you know, and then we risk score, then we give them a loan offer for a 690, not an 825. Just because your snapshot says you're 825 today, maybe you're going through a hard time, maybe you haven't paid a bunch of credit card bills back and you're acting like a 690. But I can also show you 640s that would normally not get a credit offer that are behaving like 720s. So I may not give you a risk-adjusted 720, but I'll give you a loan. Maybe I'll risk score you as a 700 because your behavior is indicating that you're improving your credit score. So it's not just about what is your credit score today, what is your bankruptcy score, what are your credit attributes today, what are your credit attributes and what have they been over the past 12 months or so, and what is the indicator of behavioral, what are the behavioral indicators of that vector over time, which is a little bit different way to look at things.
So when you mention that you use machine learning, so what so you actually train the model? So what kind of data set do you use to train the model, and what is the outcome actually?
Yep. So because of regulation on the consumer side, because of regulations in the industry, what the model outputs is effectively a scorecard. It's a conditional credit policy that any regulator can look at and go, I understand how you're segmenting things. Some of our competitors have a black box neural network that's making a decision. A regulator comes in and says, it looks like you're doing disadvantaged lending. Show me how or why you're making a decision. And then the tech team can go, it's a black box. I can't tell you why the neural network was making a decision. There's a lot of efforts today to open up those black boxes to make it explainable, but to avoid that whole thing, we have a lot of data on consumer performance over the past 10 years in specific segments that we use to train the model. And the model suggests a credit policy that a human can read. And then a human, our credit underwriting team, will look at it and go, this makes sense. Let's implement, let's get this passed off, authorized by the banks, and let's put this into production. So the credit model isn't making the credit decision, it's suggesting a policy that will make a decision. So we avoid the whole regulation nightmare that black boxes can present.
So as I understand, to support the further growth, you have done the round C, like additional 15 million raised September this year, 2023.
That's right.
And which is actually like every step when you raise money, it's really important step for all the founders.
Yes, it is. Yep.
And so the question is, there are lots of challenges to do this for sure. So the question is, so how to get prepared for the fundraising as a founder?
For the seed rounds, for the seed round and for all the subsequent rounds, we were very fortunate to have people that understand the business, and that's largely, I'll say something that's a little bit risky. That's largely the difference between an East Coast investor versus a West Coast investor. A lot of the West Coast investors are like, oh, users, how many users do you have on your platform? What are your user fees? Is this a SaaS model? And we are not a SaaS model. And the West Coast, a large part of the West Coast investors couldn't understand the model. And so a large part, fintechs can often be a complex business. Like, our platform doesn't work unless we have a lender, a merchant, and a consumer. That's complex. It's not like I'm going to a business saying business by the service. No, I have to have a business that has a consumer, and then I have to have a lender that will back that merchant and that consumer for a loan. So make sure you have investors that understand the business. So many investors would say no at the last minute because at the end they're like, I just don't understand the business. It's just too complicated for me. So there are certain areas of the country, and there are certain VCs that are known that have special focuses for specific types of fintechs. There are people out there that only invest in payments infrastructure. There are people that only invest in Momnt, lending as a certain, loans and loan platforms. So find your investor that understands your business, that has a background. If you're going after a VC, make sure that VC has companies that are in their portfolio that are complementary or similar to yours before you approach them. And then outside of that, it is a numbers game. When we did an A round last year, I think we sent communications out to 250, 300 VCs across the country. We probably got 200 people that were interested, and that whittled down to maybe 3 or 4 that gave us money. And when we were doing that shotgun blast to all those VCs, we really did do a lot of research saying which VCs focus on our type of company, which VCs have portfolio companies that are complementary to us, and could they add value to us? That was the other thing that really large recommendation. When you take money from a VC, make sure that the value that they bring you isn't just money. And so some of our VCs opened up doors to large, network opportunities or lender relationships that we wouldn't be able to get into. And so even though there may have been, after 250, 300 VCs that we sort of shotgunned, there might have been 10 that were really interested and ready to write a check, but we only chose 5 because those 5 were bringing more than just money.
Mm-hmm. So as soon as you have done round C already, so what are the different value that investor can bring on the table on each of the steps, like on the seed, for the seed, round A, B, C? What's the difference between the value that founders should be looking for partnering with the specific investor in the specific stage?
That's a really good question. For the seed round, it was somebody that just believed in the team. Something that a quote that I often say that goes back to business school that I learned was that an investor, I don't care if it's an angel investor, a friend or family, a VC, or an investment banker, they will invest in an A management team with a B idea over a company that has an A idea with a B management team. So that's the first thing. Make sure you are an A team, human, the person. Even if your idea is sort of B or even C, they're investing in the people ultimately anyway. And so the seed round person, that angel investor, look for someone that believes in the vision and in the team. Anything beyond that, you're asking for fundamentally what should be growth capital. We got the platform to a certain stage. I just need money not to develop product, not to prove the concept, not to prove market adoption, but I need money to scale. I need to go from 10 people to 100 people and then 100 people to 250 people. To make sure those VCs understand the growth trajectory of the firm. Make sure you have a good use case and assumptions, financial model, predictive forecasting that you can achieve. That's the other thing. A lot of people will say, we're going to grow 50% month over month for the next 10 years. That's unreasonable. We're going to grow 10% month over month, for the next 12 months, and then we'll reassess. That's a reasonable thing. But make sure you can grow 15% or 20%. And so post seed, make sure you have a conservative forecast that you can beat, and make sure you find people that will say, here's money, and I can help make sure you can grow because I'm going to bring business opportunities. I'm going to bring, middle senior executive leadership to add to your team, to add value to the team, and open doors that you could not necessarily have gotten into by yourself. And we've been very fortunate. All of our investors believe in us, believe in the team, believe in the vision, and have been able to open doors.
Yeah, so I really like this, that you need actually to find the investor who really understand the business, not just like believe in it, but really understand the whole business model and how it works in details. So my other question in regards of this is, as soon as you have a business strategy, so how to define the milestones when you actually need to do your next round? So what are these milestones? So how would you decide that you actually need the round now, or like in
a lot of it had to do, when do you need money? So for example, Momnt was challenging because we started the company in 2019. COVID hit in 2020. We were not expecting a global pandemic right before we started the company. So advice out there, don't start a company right before a global pandemic. And so we had to stretch our financing because we were expected to get, with our seed capital, we were expected to get into revenue, not just have a functioning product in market, but actually start generating money. But COVID hit, all the banks and all the merchants basically said, COVID's hitting, give us 12 months. We're like, crap, what do we do? So we had to go back to our investors and say, give us a convertible note so we can extend it. We have a lot of good feedback. We have a lot of interested banks. It's a chaotic market. Thankfully, it didn't take 12 months before the banks came back and merchants started using the platform. So they gave us the money. We were able to extend the runway a bit. And then once we hit profitability, we told them the goal is going to be hit profitability by X month. We hit profitability that month and said, but when we hit that profitability, we want more money so we can grow faster. We can grow, accelerate. We can either take the profitability and reinvest in the company very, very slowly when we have this, this sort of the growth curve, or we can go out and raise more money so we can hire more people, hire more sales staff specifically, and go after getting more market share. So it was really about that. How much runway does this round get us? Are we going to hit profitability? Are we going to hit goals along the way that would then justify going and get more money? And those goals will be, we had certain performance metrics we had to hit, and the market responded in a way that is favorable to show that the business has life in it. And so it's just about the financial planning at that point going, this X number of dollars will get us 12 months. By the 12 months, we'll have these features in place. We'll have X number of merchants on the platforms. We'll have a lender on the platform. That shows that the market is receptive. That should justify another investment. That investment will go to growth and scalability. That will get us to profitability faster.
So sometimes I see the situation when founders, they're actually afraid of looking for the next round because they're not confident whether they will be able to grow, even having the additional money on the table. But also in many cases, because of actually they don't have this growth strategy. So I don't know if it's if it applies to you or not, but have you seen the situation when the company is stuck growing? So they have market, they have product, but they're stuck. Maybe they're a little bit legacy already, and they're hesitating, like whether they should take money, actually maybe like to rebuild their product or improve their product, or just trying to organically do something, do some changes without additional capital. So what's your thoughts on this situation?
You don't have to have a person dedicated to nothing but this role, but someone's role on the founding team must be to keep good relationships with the capital markets for that very reason. Investors will often say, I'm self-funded, or I had an angel come in and give me money, and I'm hesitant to talk to VCs or talk to other money people. As a startup, you have got to have a very positive relationship into all the capital markets all the time, because you don't know when you're going to necessarily need the money. COVID hit, we had really good relationships. People were saying, I understand what you're doing. I believe in your vision. Here's some money to get you through COVID. We know you'll come out on the other side, very, very strong. We were very fortunate. Had we not developed those relationships in 2019, COVID would have been almost impossible for us to get through. And so there's a lot of wisdom from an entrepreneur perspective, that what you fear to do is probably what you should be doing most. And a lot of people have a lot of fear or anxiety around, let me develop relationships with the local VC community or the VC community nationally, because I don't know if I'm going to need the money, and talking about money is uncomfortable, and VC and valuations and dilution is all, but that's what you should be doing. That's what your executive team should always be focusing on, securing the financial security of the company, either through revenue or through VC. And so it's difficult to overcome. There's a lot of anxiety around it. Don't find good mentors, because there's a lot of VCs that may not believe in the company, but they believe in you as a human, and they'll always be willing to give you advice. Reach out and find those mentorships the day you decide to start the company, because you're gonna rely on that guidance all through the company's history. And that's what's largely going to determine a successful entrepreneur from an unsuccessful entrepreneur. If I meet an entrepreneur on the streets, or I'm going to something I'll often ask them is, how many mentors do you have? And if they're a small company that's been around 2 or 3 years, and they're like, I have one, or I haven't really thought about it, I'm like, in my mind, I'm like, you're probably not going to make it, or you're going to have to sell it at a loss, or you're going to have to sell it at a value that's lower than what you anticipated, because you're not reaching out to the community asking for help. Nobody gets anywhere alone. That's a really resounding fact at Momnt. There are 3 co-founders, there's not one. There's 3 co-founders and the seed person, and we have a really strong management team. Nobody gets anywhere alone. Don't be ashamed of asking for help and developing the relationships with the capital markets and VCs and mentors to help guide you through those difficult times. Because oftentimes your instincts, oftentimes entrepreneurs know what to do, but they need a little bit of encouragement to get over that anxiety, that fear to go and do it.
Yeah, I think this is really great advice, to have this as a function of some of the founders, of some of the C-level leaders, the function to build these relations with the capital markets, and always have an opportunity to raise money. So this is a great advice, I think, because from what I see, many founders, they just don't do this. They don't have this role, they don't have this function in place, and when they actually need to raise for whatever reason, to improve to scale their company, they need to start everything from scratch.
Right, that's right. And if you're more likely to get a yes from someone who's been following you for 12 months, 18 months, than you are from someone who's never heard of you before. Just think of it that way.
All right. So Brian, to wrap up our conversation, so what do you think will be the next big thing in embedded lending?
I think it's going to become more and more focused, more and more customized. 5 years ago, 10 years ago, you'd go into a bank and no matter who you were, you would get a 9.9 loan for whatever it is you wanted. And today with Momnt, we know consumer psychology and consumer behavior. So we have loans that are focused, that do well within the context of the person requesting the loan. And so I think the next big innovation is going to be another step in customizing the loan offers and the cost of the loan for a consumer in a given context, all in real time.
Mm-hmm. So, and again, we talked about the machine learning, and I need to ask you this as well. So the obvious use case would be like anything related to underwriting, but do you see any other use cases how the machine learning can affect the real-time lending going forward?
I do. We call the company Momnt because it's moment of need lending. And the use case is when I go to my mailbox, I have 45 different pre-approved credit card, installment loan offers, whatever. I don't need a loan when I go to my mailbox. I need a loan when I'm talking to my dentist about the orthodontia of my twins. They need braces. That's $12,000. I need it. So it's about the moment. And so about the moment of need. AI can be even more supportive of finding the right consumer at the right time when they need a loan for a thing, whatever that thing may be. I see that you keep visiting car dealerships. Maybe you need a pre-approved offer for an installment loan for a specific car. I'll go ahead and get that going for you so that when you walk into a dealership, you have confidence that you have a good offer for whatever car and your budget is set at whatever the loan terms are. We're not quite there yet. Machine learning can do a lot for anticipating those needs of consumers in the time when they need them, not when I go to the mailbox, not when people cold call me, on my cell phone or send me spam email.
Brian, so thank you very much for all these insights and for this great conversation. So I really enjoyed having you today.
Yeah, thank you for being here. It's been enjoyable. Some really good, insightful questions. You clearly know the industry.
Yeah, so and for everybody who are watching us today, so like this video, so put all your comments down below this video and ask any questions you have, and also please share the link with your colleagues within the fintech industry. So we're building the fintech community here of builders and leaders, and we share the knowledge about the industry, so you know how the YouTube works. So please share this link with your colleagues. And it was me, Vasyl Soloshchuk from INSART, and Brian Lanehart from Momnt. And let's keep building fintech together. Cheers.
Absolutely. Thank you.
Still watching us and have not subscribed yet? Let's fix this. Also, don't forget to like this video and take a look at the other episodes we have. See ya!